Thank you for joining our third session in the series on how to get better financial control of your business. Recordings of the first two sessions are available on our website. They were setting up for success and common problems. Now, there's a quick reminder of the three takeaways from our last session. We said that as a business owner, you need to be aware of the financial concepts that we've been discussing, even if you don't do all of the updates and entries into the accounts yourself, which is why sessions like this are so useful. Get to know your numbers, and that helps you to spot problems more easily. And then the last sort of takeaway was your financial accounts are a really important summary of your business. So focus on getting the numbers right when you put them into your accounting system, because this saves a lot of time and effort in the long run when you have to go back and try and correct things. So that was just sort of some high-level thoughts. Today in session 3, we're going to be looking at helping you to get the right insight to manage your business, which will hopefully lead to better business decisions being made. Things like why you set a budget, whether you should be using dashboards on your accounting systems and how you would do that, and what kind of reports you should be looking at. So as previously, we've gathered a panel to discuss our questions this week, and I'll let them introduce themselves in a moment. Please go onto the mute for the duration of the guided questions. We'll be going through the questions for about 40 minutes, and then there'll be a chance for you to ask any questions at the end. If you would like to use the chat function as we go through just to register some questions, then please do that as well. So over to our panel. I will introduce them one at a time. So Joan, could you say hello first?
Hello first. Hi, my name's Joan Edwards. I'm an accountant. I've been with BIC for about 4 years. I work on the Sustainable Scale Up cluster, but I'm also the program manager for Investor Ready. And when I'm not doing all this, I've got my own little business as well.
Thanks, Joan. And Wayne.
Yeah, hi guys. I'm a chartered accountant, so I work for Old Mill. Been chartered accountant about 10 years. Worked with small businesses, worked with large businesses as well, so I've done a bit of audit. So I've had exposure to both sizes of businesses, and then I also took the challenge of setting my own business as well. So I sort of relate to you guys and the problems you're having at the moment, and hopefully can help.
Thanks, Wayne. And last but not least, Wyn.
Yeah, afternoon, everybody. Wyn Jones. I'm a regional cluster manager for the Sustainable Scale Up cluster. Been with BIC 2 years. Previous experiences, corporate banking and scale up of a business, an SME business. Yeah, it's me.
Thanks, Wyn. So we're going to start today looking at budgeting, because we believe that budgeting is important. And for context, in your situations, what we're talking about is really forecasting forward your profit and loss account, so your turnover and your costs. So I wanted to open with a question, firstly to Joan, to say why should a business owner set a budget, and what are the benefits of budgeting?
Well, I think you need to set the budget for some strategic thinking to know where you think your business is going to go in the next year, 2 years, 3 years. It helps you set benchmarks for when you're actually then looking at your actual performance. You know whether you're below budget, better than budget, and then it gives you ideas. You can actually then go and look at why are you below budget? Have your sales not been hit target, or why are you better? Have you got better sales? And it's the sort of thing you can build in. You can start amending your budget as you go through the year. One of the things I would also say when you're putting a budget together is to try and do what we call profiling. So, you know, if your expenditure and sales are seasonal, don't put a budget in and say, I'm going to spread it across 12 months of the year. Because then what'll happen is, of course, there'll be times when you're way under and way over, and you won't actually the information you get out of your budgeting system won't actually be any useful. So that's the main reason, is to try and benchmark what you think, where you are going, where you think the company is going, and then match it against where you actually are at any given point in time.
Thanks, Joan. And Wayne, what would you say about the benefits of budgeting?
Yeah, I would almost take it a step even further back and just say, actually, you know, as a person, what do you want to achieve in the next 5 years? So when you get to year 5, you know, what do you need in terms of your income, for your holidays, for your family, for your friends, that type of thing? And then how can the business achieve that for you? And at that point, it gives you something tangible which you're aiming for. So if you hit all your targets, in 5 years' time, you're going to then have that life that you're after. It might be the business is only one part of that, and then there's other parts that feed in, but at least you know that's what it's going to get you. So it gets you excited about your budget, and that's the point of a budget. You should be excited about it. You should be able to be excited about hitting those numbers. And then also it shows you the gap between sort of where you are now and where you want to get in the future. So you can then work that gap back, 4 years, 3 years, 2 years, 1 year, and then have a look at all the different milestones that you need to hit. In being able to do that, then it improves the efficiency of the business, because actually you will go through that budget and you'll look at all the different areas of the business and you'll start to identify things, or actually, do I need that, or can I cut that out? So I think that's one of the powerful elements of doing a budget, is you then review every different element of the business. And then I'd say the other thing is that if you're trying to build something in 5 years' time, which is significantly different to where it is now, it's going to make you think about things like, do you need new staff? Are you going to need new equipment? If you're going to need those things, then are you going to need investment to bring into the business? We're going to need loans. So you need to build the base of that now, and then factor that into your plan going forward.
Great, thanks, Wayne. Let's just move on slightly then to actually how you would set a budget and some practical tips on where to start. Wyn, maybe could you pick that up?
Yeah, sure. Like with a lot of things in business, I like to use acronyms, and the one that springs to mind here is the SMART acronym. So where SMART means specific, measurable, achievable, realistic, and time-bound. So in terms of budgets, the two most important words there are, is it achievable and is it realistic? There's absolutely no point at all in creating a sales budget which is based on hopes and dreams. You've got to be looking at the market you operate in, thinking about the competition, and working out where realistic sales opportunities exist. Also, I'd stress in some slightly bigger businesses where you perhaps have a sales team and you have a finance team. It's no good the finance team setting the budget and then just saying to the sales team in December, you're okay with doing 30% sales growth, aren't you? It's got to be a joined up effort. So all team members have got to have some input into this budget to say what is, and I repeat, achievable and realistic. It needs to be challenging, sure, but it's got to be realistic. There's no point in doing it otherwise. That's all I would say.
Great, thanks, Wyn. Joan, anything else to add on how to set up a budget?
Obviously, you need a basis, and for most people, the basis is going to be historical data. But what you don't want to do is just take last year's numbers and add 2% on or 3% on for inflation. You need to be looking at what you're spending your money on, and also looking at where there's inflation, like electricity. People are desperately trying to work out what their electric prices are going to be for the next year or two. So that's the sort of thing you need. You need that basis, but you need, as Wen said, you need input from people to say, you can't just say, well, your sales are going to go up £1 million, go out and raise another £1 million worth of sales. You have to talk to your team behind you and say, right, okay, what is realistic? As it has to be, as you say, realistic and achievable. But if you're hitting your targets very, very easily, then perhaps it's not challenging enough. So that's the sort of thing, again, you need to be looking at. If every month your sales team are sailing over your budget projections, then your budget projection is too low.
I'd add to that, because if you think about it, if you're say 80k now and you set a budget 100k, you might think to yourself, okay, I'll do similar to what I'm doing, but I'll just increase my effort and I'll do a couple of little things different. But actually, if I was then to say to you, you're going to do £1 million next year, suddenly you step back and you go, okay, well, I need to think outside the box. I'm going to need to do different things, and you get more creative. And okay, maybe don't hit that £1 million, and it should be achievable, like Wyn said, but it's certainly better to aim for something bigger and just miss it than it is to aim for something smaller and hit it.
Yeah, and just building on that, Wayne, what if you're not hitting budget, what would you say to people who find that the question the relevance of their budget?
Yeah, I'd say, well, first of all, can you cut costs, I suppose? So have a look at your gross profit margins, and is there any ways that you can reduce those, increase those gross profit margins by perhaps cutting some of the costs? And I know we're going to talk about it later, but that might be things like negotiating with suppliers and seeing if you can get a better rate with them. The other thing you can do is increase effort. So, have a think about, actually, are you doing enough? Or is there more you can be doing? Can you be doing more marketing and sales? Can you get involved in different areas of the business which you weren't before? And then, like I said, in terms of increase sales and marketing, there's different things you can do and get marketing help from external professionals, but then make sure that there's a good return on investment. So what you're paying for the marketing help is actually covering, getting more back from it. Self-improvement. So is there any studies you guys can enroll on? Can you take courses? Like, you guys are here already, so you're doing a great job. And of course, BIC innovation. You guys can probably help increase your sales and marketing as well. I suppose what I would say is that, yes, review your costs, but you can only ever reduce your cost by so much. You can increase your sales and marketing by infinite amounts. So that's probably the area to focus on more.
Great, thank you for that. So let's now just move on to consider people's balance sheets. So that's your asset and liability balances at any point in time. So things like cash, stock, debtors, creditors, fixed assets, loan balances, anything that is a balance at a point in time. Now, why should a business owner be looking at their balance sheet, this accounting term? Wyn, could you help us with that?
How long have you got? It's lots of reasons to look at balance sheets. It's very common for business owners to focus on the profit and loss section of the profit and loss of the accounts, because that shows out how much profit you're making fundamentally. But the balance sheet can often be disregarded, which is a dangerous thing to do. It shows really what is your business worth fundamentally, and you need to be looking at trends either year on year or preferably month on month to see, is actually the worth of your business going in the right direction. And then within that, other things you should be looking at are your cash flow. Have you got too much cash tied up in stock? Have you got too much cash tied up in debtors? Are your debtors paying you in time? Are your creditors getting out of hand? Are you paying them when they're due, or you're stretching the credit all the time and getting into trouble? So the balance sheet is a source of a lot of valuable information for you. We could go into great depth into loads of other items in there, but what I'm saying is start to have a look at it on a regular basis and monitor trends. Your debt is increasing. You can even do a few simple ratios and work out, on average, how long are my debtors taking to pay me? Or on average, how long is my stock staying in stock? Could I actually buy less, but get it in more frequently without having to pay too much money? Could I talk to the supplier and say, right, I'm going to need whatever, £50,000 of this product through the year, but can I draw it down when I need it rather than holding on to it and tying up my cash? So the balance sheet is a source of lots of valuable information. Particularly, I'd say, I suppose, to sum it up, cash flow is everything. Cash is king, as we all know. So I'd be focusing on stock, debtors, creditors, and cash to understand where your cash is at any one time. And is it tied up? What worries me often is, are you actually being a banker for your supplier or for your customer? So if you allow them too long to pay you, you're effectively being their banker. Well, don't do that. Let them go and see their bank if they need some credit. You're not the source of credit.
Thanks, Wyn.
What I'd add to that, Wyn, is that, if you're looking at short-term assets versus short-term liabilities, it's going to give you a good indication of whether you're going to be okay for the next few months as well. But when you're looking at short-term assets, have a look at cash and debtors. You might want to take stock out of the equation because stock can take a bit of time to move. So have a look at those short-term assets, the short-term liabilities you've got, and whether you're likely to be okay going forward. Just bear in mind the limitation of a balance sheet. It's a snapshot in time. It's going to look at the next year, but it doesn't give you the timing profile. So it might be that all of your creditors are due tomorrow, whereas your debtors are due in 30 days. So the balance sheet is not going to show you that. So that's just something to keep an eye on.
Yeah. So, Joan, what would you say are the key sort of balance sheet numbers to keep your eye on, and how frequently should people be looking at this kind of thing?
Well, I think one of the key ones, as Wyn was saying, is cash flow. So debtors. I had a client recently went to the bank. Her balance sheet showed a massive amount of debtors. So the bank said, well, we won't lend you money. You go collect it from your debtors. And again, a classic example is Wyn saying, I had a client who's overdrawn at her bank account because she's got a debtor who insists on paying about 90 days late. And the reason the debtor's paying late is because they don't have an overdraft facility. So she's paying overdraft fees because her debtor can't. And I'm saying you can't do that. It has to be, if they're like that, it has to be cash on delivery, basically. So she's basically become a banker and she's incurring costs because her debtors aren't paying her. So debtors, you should be checking, I would say almost weekly, you should be running your aged debtors report and seeing who owes you money over and above the terms that you have agreed with them. If you agreed 30 days, you should be phoning them up on day 25 and saying, will you be paying us on your next payment run? Don't wait till it becomes an overdrawn debtor. Get in there first. That's the main thing. And the other thing is, of course, stock. As Wynne saying, do you have masses of stock sitting in your warehouse, which has cost you money, but you don't need it for 3 or 4 months' time? You need to be looking at your stock levels and can you cut them down? Can you turn to almost a just-in-time system?
Yeah. Wayne, what do you find from your sort of clients that you deal with? Sort of when you're talking about balance sheet accounts, which ones sort of do you end up challenging and keep coming back to?
Yeah, I mean, debtors is one where people are not chasing them in, and then, like I say, cash is the other one. Just make sure you've got enough cash, because if you don't, you can't run the business. And the guys have mentioned, certain times if you are short on cash, what you can do, but there's maybe a few other things. So, for example, with your suppliers, can you stretch out those payment terms so you don't pay them quite so early? We find a lot of our clients do that. They get the invoice in, they pay it straight away. So consider stretching those out. Yeah. Can you get customers to pay quicker? So perhaps offer them an early settlement discount. I mean, in my business, one of the suppliers said to me, look, we'll give you 2% off if you pay quicker. So, okay, I'll do it. I've got the cash, I'll do it. Otherwise, I would have just left it as long as I could. In terms of new assets, you might buy new assets for the business, but do you need to then buy them straight out, or can you have them on HP or some sort of finance? So if you have them on finance, it's going to spread the cost of the asset over the income that you're going to get from it. And you can also, the interest is tax deductible. So it's going to reduce your tax bill as well. Payment plan with HMRC for VAT, corporation tax. They did this over COVID. They let people have a payment plan. It's not ideal, but if you had an issue, you could call them up and you could probably get on a payment plan. Again, Wynne talked about having an overdraft. I would say with funding, match it to your requirements. If you need funding for a very short period of time, then an overdraft might be great. But actually, if you think you're going to need that funding for a longer period of time, then consider something like a loan. So try and match the term of the finance against the lending. And the reason is because, overdrafts are expensive in terms of interest. You don't want to be in there for too long, and in which case you would negotiate a loan. Yeah. And then, we talked about increasing in your marketing efforts, like bringing cash. And then there's a couple of other sort of external things you can do, which I won't go into at the moment.
Okay. So, Wynne, could you just sort of explain to people a little bit more about the banker's perspective, and when a banker is reviewing your balance sheet, which they will often be doing as part of a sort of due diligence review if you're asking them for money? What does a bank look for on your balance sheet?
Okay, all sorts, and even a bank these days, where you don't actually have a relationship manager, you just send your accounts in. They will be put into a credit score system, so their computer will be looking at your balance sheet. So don't think nobody's looking at it, they will be. Three major things to look at is, one is what we call liquidity. What that means is, and Wayne was referring to it before, it means has your business got enough cash there to pay invoices as they fall due? So it's all right being profitable, but if you haven't got the cash flow, your business is going to fail. So a bank will be looking at the liquidity. In other words, the relationship between debtors, creditors, cash, and stock. And in fact, on your balance sheet, it will usually calculate your current assets less your current liabilities, and that net figure is your liquidity figure, really. And I've seen businesses where the liquidity is actually a negative position, and that's really worrying for a bank. They will always calculate the liquidity ratio, the ratio between current assets and current liabilities. I mean, if you want to know more about that, we can contact me anytime. I'm sure Wayne would be happy to take a call, but In essence, it's looking about liquidity. Second thing they look at is what we've already talked about, cash flow cycle. The computer will often calculate your debtor days. In other words, the average time your debtors are taking to pay you. It's incredible when you work it out. You might think, oh, my debtor's paying me 30 days. But when you do the numbers, you might find the average payment time is 45 days. It's worth looking at yourself because the bank will certainly look at it. And they'll also look at how long stock takes to turn over in your business. So are you carrying the stock for too long? Are you buying it in too early and getting in too much? So the bank will look at that. And one final thing, I don't want to bore you with ratios and calculations, but another thing to look at is called the gearing ratio. So the gearing ratio calculates any existing debt in the business and it compares that to the actual value of the business. So is your business over dependent on debt essentially? Because if it is, it's obviously got to service all that debt, and any profits you're making are being used to make repayments on the debt. So three things are on the balance sheet. The bank would look at liquidity, cash flow, and gearing. If you need more detailed explanation of that, I'll happily provide it on another day.
Win, is the gearing, is there an optimum gearing ratio in terms of the point where the bank starts to say, okay, that's too much?
The answer has to be it depends on what stage of its cycle the business is. Is it a new business, a mature business, what it's trying to do, and its cash flow. It will look at liquidity, cash flow, and gearing combined. If it's got the cash flow and profitability to service the gearing, it's not so bad. But if they're looking to take on more debt, for example, and it's already heavily geared, that could be a problem. Normally about 75% is just about the comfort area. But I've seen much worse cases than that, and the bank actually does the lending because there's different factors involved. Yeah, so there's no right and wrong because it's a combination of those three calculations, really.
I suspect also that the sector is important for a bank. I know we're all in food and drink, but I've worked in the construction industry. Construction is notorious for having no cash in the bank, whereas I've also worked in the travel industry, you've got loads of money in the bank, because obviously people pay for the holiday in advance.
Yeah.
So it will depend on the sector.
Yeah, and I guess what it's for, because if you are doing it because you run out of working capital money, that's very different to if you want to invest in something which is a project which is going to help you grow.
Yeah, the bank obviously look at lots and lots of things, and particularly these days they look at the people, the management. But as we're talking balance sheet, it's those three ratios generally. I could do another half-day session just on what banks look at, but let's just look at the balance sheet. Three main things: liquidity, cash flow, gearing.
Thanks all for that. We've talked quite a bit about cash, and one thing that we're always communicating around what should people be looking at. We know that people should be looking at cash and cash flow, but how does that link to profitability? Because we've got two very different sort of like things that we're telling business owners to look at. You've got to manage your cash, and you've also got to make sure you're profitable. What's the relationship between those two things? Maybe Wayne, could you just pick that up?
Yeah, sure. It's very important to realize that you can have a very profitable business and still go under, and it has happened to some of our clients. I mean, if you think about it, if you're quite small and Tesco come to you and they say, I want to place this massive order, you then have to go to your supplier, you have to pay them up front for some of the work. They'll then produce something for you, send it across. There's going to be a lag time sending it across to say you bought it from abroad. You're going to have to then take that product, turn it into something, sell it to Tesco, get it delivered, and then they're probably going to want 30 to 60-day payment terms. So actually you're in negative cash all the way through until you get that money back. You might have some payment terms with your creditors, but that's still going to mean that you have to invest. So you can be very profitable, but then have no cash. So that's one thing to consider. The other thing is, like, if your cash is going up, then that's great, but just bear in mind a few things. For example, do you have tax liabilities which you haven't paid? So perhaps you're getting VAT in and you're not keeping it to one side. So it looks like you're really profitable, money's going up, but actually you need to pay it out anyway. Have you got new stock in, or are you running low on stock? You're gonna need to spend that money to buy new stock. Seasonality is a big one. Bear in mind the fact that you might have had a busy Christmas period, you've got loads of cash in, but don't spend all that money, because actually you might need to invest it in Easter, for example. You might need to get loads of stock in to then sell it in Easter. So just bear that in mind if you've got good cash reserves. Creditors, do you have them building up? And the other one that people often miss actually is loan repayments. So, I've got a bit of cash in the business, I can spend it, I can invest it, whatever, but actually, have you got a loan coming up? Or do you need to declare a dividend? Do you need to pay out to shareholders? So those are the things to sort of look out for. I would say definitely profitability and cash are not directly connected.
Yeah, thanks for that, Wayne. Any other comments on that from Joan or Wyn around that relationship between profitability and cash?
No, but this is again comes back to where your budget comes in. You have a budget for when you're going to spend things out and when you're going to receive the money for that payment. So when you're putting your budget together, that forms your cash flow. If you raise sales invoices in April, you have to remember that income isn't going to come until May. Don't put it in April. And so this is the seasonality that Wayne is talking about. You're spending money in one period to make a product, say massive products for Christmas, but you're not going to get that income in till January, possibly even February. And that's the sort of thing your cash flow forecast should be looking at.
With the cash flow forecast, we tend to do 13 weeks out. It can be daunting to try and think of a cash flow 1 to 5 years, but as a minimum 13 weeks, and then you can start to see if you can be okay over the next couple of months. If you've got seasonality, you probably need to push it out further.
Yeah. Okay, thanks all. Let's go back to a little bit more of a look at the profit and loss, and how often and when should you be looking at your profitability, Joan?
I would have said minimum should be monthly. In fact, monthly is probably more regular. It's possibly not worth doing it weekly because unless you've got weekly paid staff. If you've got monthly paid staff, there's no point in looking at for the first couple of weeks of the month when your salaries, your massive bill is going to go out at the end of the month. So I would say minimum monthly should be your regular look at it when all your income is in for the year, for the month, and your main expenditure's gone out, like your salaries. That's when you should be looking at it.
And how do you cope with seasonality? If you've got very strong months and very weak months, how would you say people need to think about that?
Well, I think again you need to bear in mind, one would assume that if you're a very seasonal business, when you're in one of your downturn periods, you would not expect the same salaries levels. I know there are people who do pay their people to keep them on even when they're not actually working. I know a couple of businesses that do that because they don't want to lose the staff. But basically, you should be looking at you spreading those costs evenly over the year rather than, for example, I've got somebody who employs half a dozen people in her cafe. The cafe closes over the winter, but she still pays them a salary. So again, you need to make sure that you are aware on your cash flow projections and when you're looking at your profitability, that's what's happening.
Yeah, I think that's when your budget would come in as well, because you'd have that seasonality mapped in. Yeah. But also, if you have a look at the same month last year, that's usually a pretty good indication rather than looking at last month, because that might not be relevant.
Yeah. And Wayne, just pick up, what are the key sort of profit and loss metrics that you think people should be looking at on a regular basis?
So I think, overheads is one, but there's less you can do overheads. Gross profit margin would be the one, making sure you've got a good gross profit margin. And I think if you haven't got a good gross profit margin, then what can you do about it? You can increase costs, and you can actually do something called grandfathering if you want to. So you can actually leave the people that you have already on the same price and then just increase the price for the new people. Negotiate discounts with suppliers. This is stuff we talked about earlier as well. When it comes to bulk discounts, just bear in mind, and I think we talked about this on the last one, if you do go for a bulk discount, you've got the cash available to do that, because you might get something in cheaper, but actually then it's going to sit there for ages and you've not got that cash to reinvest in marketing, advertising, whatever you need it for. So only go for that bulk discount if you think you're going to need it. Compare suppliers. And what I say about comparing suppliers is just make sure that you've got a supplier which is good communication and a good quality of product. You can go compare suppliers and you'll find a cheaper supplier elsewhere, but actually, are they going to help you when you've got a problem and you need to send stuff back to them? or are they just going to abandon you? You can understand your gross profit margin per product. And if you haven't got the detail of that data coming in to the profit and loss account, then perhaps just map it out on an Excel sheet. And then what you can start to identify is which products are more profitable and which ones aren't. And then you can then focus towards the ones that are more profitable, and then maybe less towards that aren't, unless they're a loss leader. You might need that low margin product to bring people in to the business, and then they'll buy the higher margin products from there.
Okay.
And then, like I said, if you are short, consider increasing your marketing efforts. There's a difference between something which I call roads and traffic. So a road would be an angle into your business. So say you set up a YouTube channel, you set up an Instagram channel, that type of thing. That's ways people can access your website or come to you. But just because you built a road doesn't mean there's going to be traffic on it. So the ways to increase traffic would be to, paid ads, for example, Instagram Reels, YouTube Shorts, TikTok, they all go to people outside of your normal database, and then they'll pull in. So I'm touching on marketing here, but just try to show another way you could possibly increase your sales.
Okay. Wyn, what would you say about sort of the key profit and loss metrics that people should be looking at regularly?
Well, obviously, as well as gross margin, as Wayne has rightly covered, net profit. If it's, for example, you've got a growing business and your turnover is going up and your gross margin is staying the same, things are going fine, just make sure your net margin is going in the same direction. Net profit margin I'm talking about, because often you can be spending an awful lot on overheads to achieve the extra sales, but it's not showing in the gross profit position. Also, I would I'm a bit ruthless because I used to be a bank manager. I always get a bit aggressive over unnecessary costs in your overheads. I can remember one bus company I looked after once, and I wondered why they'd spent so much on number plates. So they had 20 personalized number plates, all match the name of the company, bought in one single year. And it's just nonsense, because once the business was growing, it suddenly thought, oh, we're doing well, we can spend on all these trivial things which don't actually enhance the business in any way, shape or form. And bankers always look out for that kind of stuff. They come and see you, visit your property. If they see a nice fountain in the front and some flagpoles and posh cars in the car park, they're not going to be impressed, because that doesn't do anything for profitability or cash flow. Anyway, that's my rant over. But yeah, net profit margin is important to keep an eye on that as well, and make sure it's trying to keep as good as it always has been and not being eroded as you grow.
Yeah.
The thing on net profit, Andrew, I'd say is that make sure you're making enough to take the money out of the business that you need to in terms of dividends, but also, are you making enough to reinvest, R&D, equipment, staff, that type of thing? Yeah.
Yeah, and just maybe just to say something about the timing of thinking around sort of reinvesting into the business. When should people be doing that?
Well, I guess that feeds back into the budget. So if you've got your 5-year plan and you know where you want to be, as you've mapped that out, like I said, I'd start at the 5th year, look at the revenue, and then see what the gross profit is. If that's not enough, then tweak the revenue, work back to year 4, year 3, year 2, year 1. And then to get to year 1, you can have a look at the different months and what you're going to hit. So you'll start to identify areas where you think you're going to need new equipment or new people to satisfy those new targets.
Okay, so Joan, can you just maybe just pick up on anything else around? We talked about Wayne talked about gross margin a fair bit, but what is there anything else that you can do if your gross margin isn't big enough?
I think it's a case of, again, coming back to your budget. For example, the example I gave earlier, she knows that particular client, she knows that she will make a loss in 2 or 3 months because she's paying salaries for people that are not actually working. But in the summer, those people make up for the fact that they've been paid for not working by working 60 hours a week. So that's the sort of thing why you need a budget. If you understand that you are not going to be rolling in money in those months, you need to make sure the months beforehand that you have sufficient money and sufficient reserves in the company to carry you over that period until the production picks up again.
Yeah, there's a small one, Andrew, I can think of actually, which I didn't cover earlier. when it comes to postage, can you adjust the size of your product so that it fits into the next postage bracket down? And especially if you're e-commerce and you're sending loads of stuff out, is there slight tweaks you can do to save you money in that area as well? Because I know one of our clients has saved quite a significant amount of money just by slightly reducing the size of their postage, and then they were a small parcel as opposed to a medium one.
Yeah.
Yes, I've got a few who a parcel up to a certain weight is free when they order more, which is ironic because most people, you think the more you order, the free package. She actually charges more for more when it's over a certain I think it's 2 kilograms, isn't it, the post office? So any package that's over that and is on the next box up, she charges.
Yeah, understandable. So, Wyn, let's move on to overhead recovery again. And how can you say something about how people should manage and make sure that they do recover their overheads?
Sure. Yeah, your overheads fundamentally costs which are not directly related to the production of the product, and it's important to be really close to the costings of your products, understanding exactly what it costs you to send that product out the door. And that includes your direct costs, labor and raw materials, but also which overheads are spending on it. If you understand exactly what costs need to be attributed to each product, I thought of an example which would be, if you're a business which was selling food, but selling some at ambient temperature and selling some at frozen, but in your overheads, you've got some high energy costs. Well, your energy costs are probably relating to the freezing of the products. So a big portion of that energy cost needs to be attributed to the frozen products, because your ambient temperature products, you're not having to freeze them down or keep them frozen. That's just one example. Once you've established the true cost, you've got to ask yourself, well, is that product line really as profitable as I thought it was? And you may have to adjust some product prices upwards to accommodate the overhead that is actually going into keeping them and to producing them. Sounds a bit complex, but if you know your product really well and understand the absolute costings of every product, you'd be a lot closer to managing your overheads.
Yeah. Thanks, Wyn. I think we've covered quite a lot of ground again. If I just finish the questions with asking each of the panel members to say what's one of the most important things that you think the business owner should be remembering out of what we talked about to get the best financial insight into their business. So Joan, could you go first, please?
Well, the most important, I think, is cash flow, and that's coming back to debtors. Chase your debtors, make sure they're paying on time, give them incentives if you have to. And again, the client I talked about earlier, she put her price up for that particular customer and then offered a discount if they paid within 30 days. And that price after 30 days was the price she was charging them anyway. So that's what she did. Stock, look at your stocks, make sure you're not carrying, particularly packaging. People tend to buy thousands of tons of packaging which sit in a warehouse going moldy. Make sure you're not carrying loads and loads of packaging and loads of stock that you don't need or you won't need for some considerable time.
Thank you. And Wayne?
I would say the goals side of things. So again, getting that budget in place so that in year 5, you're aiming for something, and you're not just aiming for a number, you're aiming that number has a reason behind it. If I hit this number, I can do this, this, and this. That's going to make you so much more passionate and excited about hitting that number. So get a budget in place, work it back, and see what you need to do every year to hit it.
Great, thanks. And Wyn?
3 things for me, really. It's about the accountancy side of it. One is, as we've said before, take great care with your inputting, make sure it's accurate firstly. Secondly, when you get your monthly reports, monitor the trends, monitor them regularly so you know exactly what's happening in the business. And third, and most importantly, when you see the trends, whether they're negative or positive, do something about it. Don't think, oh, I'll do it next quarter or next year. No, do something now. If the trend is going the wrong way in particular, highlight exactly why that's happening and do something about it. That's what the information, that's why we gather all this information. It's for you to make decisions and do things with your business.
Great.
I think even if it's going well as well, Wyn, consider it, because
absolutely, yeah, do more of it.
Yeah.
Well, thank you very much, panel, for your views and comments. Just open up, is there any questions that this has raised for anybody on the call that they'd like to ask to the panel?
I just want to add that since we're food and drink businesses as well, when we spoke about stock, expiry dates is very important. So again, you don't want to be buying stock that has an expiry date which you can't use. So the key thing is also food and drink does have expiry dates, and they can be quite short. So just make sure that you manage your stock for that as well, because otherwise you don't want to write it off as a cost to the company.
Yeah.
You know, first in, first out.
Yeah, thanks, Kevin. Any other comments from anybody? I just wanted to I guess just cover next steps now, because we finished the sort of series of 3 guided discussions that have hopefully raised some thoughts for our business owners. If there are specific requirements that you have identified because of this that you need help on, that could be around changing the way your accounting system is set up. It could be on resolving some issues that you found in your accounts and your finances, or it's just on help in terms of building sort of your insight and your reports that you use regularly and getting support on that. We're here to help you. So what I'm going to be doing is sending an email to everybody who's come to any of these calls to ask really what their feedback is and what they've heard, but also to understand any specific ways that we can help you going forward. So we have our Old Mill Accountant sort of available. We've also got the Investor Ready program that Jonah heads up, where they can come in and both of those parties can provide specific help to sort of resolve issues or set things up for you. So that's something that we'd like to offer to people. The other thing we talked about as well was a special interest group going forward, which would be potentially, we'd have different ones for different accounting systems. I think most people have Xero, so that might be the first one that we would set up if there is a continued appetite for that. So I'll ask people whether they're interested in joining. What it might be once a month, it might be less frequently, but just a point where you can get together and talk about any challenges that you have in how you're using your accounting system, and just a forum to sort of provide support and help to each other. So that's some of the things we're thinking about going forward. So I'll be sending an email on all of that. If there are any sort of reactions or thoughts sort of based on any of that, then please do share now. Otherwise, I will. I think we can finish the call. Thank you very much for joining, everybody, and yeah, we'll be in touch to discuss how we can help you further going forward. Thank you very much.
Thanks.